Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today's going to be fun. I know that I have a lot of new attendees out there in my live stream webcast. There are a lot of people who are just now trying to learn about this very interesting world known as options trading. So that's what I wanted to talk about today. We're going to be talking through what an options contract really is, and we're going to be illustrating that using a story and a live example. So that's just a current real-time example, but we're going to be walking through the ins and outs of an options contract in the simplest terms I can provide. And we're actually going to be placing a trade before we're done today, so it should be very interesting discussion. Before we can get into any of that, though, let me first of all say hello to everybody who's chatting in. A lot of people out there in the YouTube live stream audience. So hello there, Jim and Lawrence, Eric, Kevin, Becca, Lisa, Reggie, Selva, Scott, Ricebird, Trader Joe, Roger, Yale, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. The recordings are a great way to watch these webcasts. But if you like to be here in the live stream audience, you're certainly invited to join us here. This is a Tuesday webcast series. We kick things off promptly at noon Eastern time. Love to have you here in our live stream audience. Also, as a very special treat for my live stream audience members, my good friend Michael Fairborn. Mike Fairborn's hanging out in the chats with us. He's going to be addressing any questions that I can't get to just during the flow of the presentation. He'll be keeping an eye on that chat window. If he sees a question and I don't grab it, Mike's there to pick up my slack. Mike and I have been working together now for more than 20 years. That's a bit, I guess, about 20 years, right, Mike? But in any case, he brings a ton of experience to this discussion. Thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. For example, you can find Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. You can also follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. But today, again, it's always exciting for me to talk with someone who's trying to learn about options for the first time, because it's kind of fun to learn about something new. So let's dive into this. And as we do, the first thing that we're going to do is, of course, recognize that there are risks associated with this undertaking. So bear these important disclosures in mind. Options carry a high level of risk and not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's get this rolling. I want to start things off with a quick agenda. But as I do, I can see about 500 people watching the live stream right now. Why don't you do me a favor here? Chat in. Let me know if you would consider yourself to be one of those who's just now learning about options. Maybe you don't know anything about it. You just want to learn the basic concept. Chat in. Just a quick yes. Everybody's somewhere along their own personal learning curve, so there's no shame in being new to a new concept. But as you do, let's set that agenda for today. So the thing that I want to start off with is a real story that actually happened. It was a discussion that I had with my brother. My brother's a truck driver, and he asked me how options worked. So I want to tell you the same story that I told my brother Grant. Then we're going to take that story that's going to give us some new understanding of how options contract, what they are, and how they really work. And we're going to go apply that to a stock right now. So we're going to be setting up an example trade scenario and just talking through how an option on that stock might work. And we're actually, before we're done, we're going to place an example trade. All right, so let's go. First of all, I have to say this. We're going to be using a trading platform. It's not going to be familiar to everybody. It's called thinkorswim. It's available as a download. It's software that you can download free of charge from within your Schwab Online account. And I'm using it for a very specific purpose. thinkorswim has a practice version that allows traders to trade new concepts like options totally in a no-risk environment. So it's called paper money. But if you're not familiar with thinkorswim, let me show you where you can get that in your Schwab Online account. So you just log into your Schwab Online account. So here we are in an example empty online account. And you just go to the Trade tab. And under here, under the Trade menu, you'll notice right there it says thinkorswim for your desktop. It's a download. So I'm going to click on thinkorswim desktop. And from there, you just click the big blue button right here that says Learn how to enable thinkorswim. And it'll talk you through what thinkorswim is, how to download it. It's going to download it to your desktop, your laptop, or whatever. And then you can just launch thinkorswim there. It'll create a little icon on the computer's desktop. It looks like this. It looks like this blue splash right here. That's the thinkorswim splash. Anyway, you log into thinkorswim using your Schwab credentials. No special set of username and password that you need. But this will allow you to log into thinkorswim, and you can choose whether you're going to be doing what's called paper money trading or trading your actual live accounts. It does give access to live trading, but there's a little toggle that lets you choose thinkorswim. All right, so let's go to thinkorswim, and I'm going to park things here on a chart of Allstate. I'll let you look at that Allstate chart to your heart's extent while we talk about this little story. It's an interaction that happened between me and my older brother, Grant. So Grant, as I mentioned, is a long-haul truck driver, knows nothing about the world of the stock market or options trading, those kinds of things. So we were out driving along, not in his semi, but in his pickup, out for a cruise with brothers. And Grant says, "So Cameron, tell me about these things called options. I hear about options. What are they?" And I said, "Let me explain it this way, Grant." Grant's a homeowner. So I said, "You've probably been paying attention to what's been happening with real estate, right?" "Yeah, real estate. I'm here in Utah. Grant's up in Idaho. But real estate in both of those states has just skyrocketed, as it has in so many other marketplaces in the U.S. And I said, "So Grant, let's just imagine you've been watching what's going on with real estate, and you're thinking, you know what? I'd like to get in on this. I'd like to have some exposure to this rising value of real estate." So you look down the road and you see Mike's house. Mike's another brother of ours. And he doesn't live next to Grant, by the way. Anyway, but we'll use his name for convenience purposes. So Grant, you look over there at Mike's house, you think, ooh, Mike's got a nice house there. I think maybe over the next 6 months, maybe Mike's house will go up. Let's say it's a $300,000 house. Let's say that you think that the house might just go up in value over the next 6 months. So with real estate investing, what might we do? Well, you might just go see if you can work out a contract and buy Mike's house. But instead of doing that, which would cost $300,000 at that hypothetical market price, you have this brilliant idea. So, somebody says, how long is this webcast going to be? Our webcasts are 45 minutes, okay? So you have this great idea. You go to your sock drawer, Grant, and you grab a big wad. You got $5,000 in your sock drawer, big roll of bills, and you have this idea. You walk down to Mike's house, you knock on his door. Mike opens the door, says, "Hey, Grant, what's up?" And you say, "Hey, Mike, I have $5,000 and I want to give it to you." This perks up Mike's interest. And Mike says, "Okay, Grant, so what's the catch here?" "Well, the deal is, I think I might want to buy your house, maybe sometime in the next 6 months, but I haven't made my mind up yet. So rather than buying the house from you right now, and maybe I'd just pay you $300,000 for the house, how about we make a little contract with one another where I give you this $5,000, and in exchange, you give me the promise that you will not sell your house to anybody else but to me over the next 6 months, and we'll just agree that if I decide to buy your house, I'll pay you that $300,000 at that point. So that's the deal. Will you accept this $5,000 that I'm paying you?" And Mike's like, okay. So I get $5,000 out of this, right? "And if you decide to buy my house, you pay me another $300,000. That's right. Yeah, the $5,000 is not a down payment. It is what's known as a premium to secure this right to buy the house for $300,000 for this fixed period of 6 months. That's the deal." All right, so worst case scenario, I wind up selling this house to Grant at what is current market value, $300,000. All right, Grant, let's do the deal. That, in a nutshell, is a summary of an options contract. Grant now has the option to buy Mike's house, does not have the obligation to buy Mike's house. Now, in the fine print of the contract, isn't there always fine print? Yeah. In the fine print, it says, oh, by the way, Mike, if I, Grant, decide not to buy your house, if the contract hasn't run out of time yet, maybe I'll just sell this contract to somebody else, and that new owner of the contract will have the right to buy your house. So the contract is transferable. So let's just map out some of the facts of this contract, okay? So let's open up in this left column of thinkorswim what we call our scratch pad. And these are the contract terms. Number one, it provides the right to buy an asset. In this case, it's a house. Number two, we have the right to buy for a specified price, or the price at which we struck a deal to maybe exchange this house. We strike a deal. In this case, the deal would be $300,000. We would refer to that as the strike price. Does that make sense? Number three is that this is for a fixed period of time, or in other words, there's an expiration attached to this deal. Number four is there has been a premium paid, just like when you buy insurance, you pay a premium. When we buy an option contract, we pay a premium. So in this case, that would be the $5,000 paid from Grant to Mike. Now, finally, this is a transferable contract. In other words, Grant buys the deal. It has 6 months on the contract. Maybe he gets a month into it and he says, you know what? Never mind. I'm going to sell this deal. I'm going to sell my remaining 5 months to someone else. Let them sit around and see if Mike's house goes up in price. And he might get $5,000 for that deal. It might get more than it. It might get more than $5,000. It might get less. Right? John's saying, boy, this is beginner indeed. Absolutely right. Yep, John, I advertised this as a beginner webcast, and that's what I'm delivering. Absolutely. Now, that said, we do certainly go into much greater detail in these webcasts in this series. So we have a whole archive of webcasts. Let me point this out. If we go, first of all, if this is your first time to one of our webcasts, it's great to have you here. But what you need to know is that we have a whole archive, a whole library of previous webcasts that we've delivered that explore these topics in different detail from different angles. So if you haven't done this yet, pop down and click on the subscribe button on YouTube right now. You can just click down below the video stream. Subscription doesn't cost you anything. It only takes a second. But if you subscribe to our Trader Talks Schwab Coaching webcast channel, this channel is where you can join these live streams. We do 7 or 8 of them every market day. But we also have archives under what we call playlists. So the playlist for this series would be called Getting Started with Options. So I'm going to go to the playlist. I'm going to scroll down here, and mine happens to be, we got a lot of series. Mine happens to be right down toward the bottom. There it is, Getting Started with Options. You can click on View Full Playlist, and you can see the other topics that we explore. Lower cost risk reduction. Here we explored something known as the covered naked call. Interesting topic. The options trading starter pack. The options trading starter pack. 3 strategies under $100 we talked about a few weeks ago. Anyway, you can find those right there. So great resource, free of charge. Make sure that you're subscribed. Anyway, let's go back to this deal that we have between Grant and Mike. So Mike accepts the payment from Grant for $5,000. Mike is now on the hook at any time for the next 6 months. If at Grant's discretion entirely, Mike has to sell the house to Grant for $300,000. So let's play some, somebody says, first time here. Thanks for making this simple and easy to understand. My pleasure. Yeah. When I was sitting there talking with Grant in the truck, I didn't have to bring up these questions. He started peppering me with questions. He's like, okay, all right, Cameron. So wait a second. So let's say we get 2 or 3 months into this and the house has gone up to $350,000. So I can seriously just buy the house for $300,000. Well, that's the contract. Yes. So that would be a $50,000 value where I really only had how much at risk all along for those 3 months? I had $5,000 at risk. I waited until it became to my advantage to actually execute or exercise the terms of the contract to buy the house. Right. Well, wouldn't that be, in this very hypothetical scenario, if I tied up $5,000 and had $5,000 at risk and I turned that into a $50,000 value, isn't that a 10x return on my investment? Yes, that is possible in the realm of options trading. And notice that 10x return required, in this case, what would that be? Less than 20% increase in the value of the house. So you can see the leverage that can be offered. That right there is a primary attraction for a lot of traders for trading options. Well, there's something else that Grant might do. Yeah, Baja Beach Bum says 10 times, woohoo! Yeah, hypothetical, right? Let's be real here. Does that happen? It does on occasion, but not all the time. What else could happen? Well, let's stick with that scenario where the house is up at $350,000. Another thing that Grant might do is, instead of having to fork out $350 grand or $300,000 to get this deal done, maybe he just goes across the street. He knocks on Andrew's house. Andrew's another brother of ours. By the way, these are not fake brothers, they're my real brothers. Let's say Grant then goes to Andrew and says, hey, Andrew. Andrew says, what's up, Grant? Hey, Mike over there has a pretty nice house, doesn't he? Oh, yeah, that's a great house. Well, would you believe it? I actually have a contract here that says I can buy Mike's house for $300,000. And Andrew says, Grant, what, you got to be kidding. That's a $350,000 house if it's a penny. Yep, it's a $350,000 house, but I still have this contract that says I can buy it for $300,000, and it says at the bottom, I can sell this contract to you. So Grant makes a deal, sells his contract to Andrew. Guess how much Andrew has to pay Grant for that contract? At least $50,000, because there's $50,000 of what we'd call intrinsic value in that contract. So this contract that Grant bought for $5, he's now selling to Andrew for at least $50. And I keep saying at least $50 very deliberately because there's still 3 months on that contract. And Andrew doesn't have to buy the house right away. He might sit around just like Grant and see if the house goes up further in value. There's still potential there. So maybe he pays Grant $51,000. Maybe he pays him $52,000, but he pays him for the intrinsic value of the contract plus what's called the time value of the contract. There we go. You're learning a lot about how these options work at this point. But the bottom line here is Grant doesn't have to exercise the option. And as a matter of fact, with many options traders, possibly I could say fairly confidently, most options traders, their objective never is to exchange the asset. Instead, it's to buy the contract, wait for it to go up in value, and then sell it. So that's been fun. We've been talking about making a ton of money on these things. Guess what else? You can also lose a ton of money on these things. What if Grant buys this contract from Mike, pays $5,000, and then Mike's house never budges? He's waiting a month, 2 months, 3 months. 6 months go by, the house is worth $300,000. Maybe it's worth $290,000, maybe it's worth $280,000, and Grant's sitting here on a contract that has zero value, and he's lost his $5,000. He might have chosen somewhere along the way to jump ship, sell the contract for what he can get for it. But that's also a possibility. So with these types of contracts, there is unlimited reward potential. The higher the asset goes in value, the more the money can be made. But we can also lose 100% of the investment, however much that is. So all of that is hypothetical. That was a fun story. That is, to me, when I think through that, it again gets me kind of excited because it's fun to learn this stuff. But now let's make it real. So this is where we're going to bring in Allstate here. Let's say that we are an options trader, or maybe a would-be options trader. And what we've noted here is Allstate has just been running back and forth between about $190 up to about $215. Over the course of the last 8 months, it's cycled through this about 4 times, up and down and up and down and up and down. And here we find ourselves closer to 190 again. Let's kind of stretch the imagination here. Is it possible that maybe somebody out there thinks this could go back up to, let's say, 215? Yeah, let's say that's our trader's outlook. So what they might do if they think the stock is down here, it's about 194. If they think it's going to go up to 215, maybe they buy the shares. And if it goes to 215, that would be about a $20 increase in their roughly $200 investment, about a 10% return. Oh, Severnengo says, what if Grant decides not to buy the house? If he decides not to buy the house, if the house is not worth 300,000 and he lets that contract get all the way to expiration, the contract just expires. It's just worthless. It's done. Zink says, at what point would the 5,000 be lost after 6 months? Yes. Now it can also lose significant value. Let's say we buy that contract with 6 months to go, and the house is worth 300,000 right at that point, and then there's a crisis in the neighborhood. Maybe, a wildfire blows through. It just doesn't look as good. House survives, but it's now in kind of an undesirable area, and now the house is only worth 250, and there's still 5 months left on the contract, but there's just not much likelihood that he's ever going to get 300,000. That contract might drop in its market value from 5,000 bucks. Maybe it's only worth $500 at that point. Maybe somebody out there thinks there's going to be a recovery and they can sell to them. But yeah, the market value of that contract can fluctuate. It can fluctuate just with stock options as well. But in any case, let's turn this assumption into what's known as a long call option trade. So we now know what the terms of the contract are. Let's just use the asset that we're trading, a stock instead of an option. So if we think the stock is down here, and right now, again, it's about 194. This is going to require a little bit of rounding on my part, but just remember, let's say our trader thinks we're likely to go up to 215, and maybe it does it in, the few weeks or maybe a month that it has in the past, the last few times that it's rallied up to this point. So let's say that we think sometime within the next month, we might be looking at Allstate as a $215 stock again. But we're seeking to leverage that, much like Grant leveraged the anticipated performance of Mike's house value. So here's what we're going to go. Here's what we're going to do. We're going to go to the trade tab, and we're going to do an example trade. And this is known as a long call option or long call contract. Okay. So here's the deal. Let me narrow this up a little bit. Give us a little bit more space to work. Notice as we look at the trade tab, down below, there are these dates under what's called the option chain. So the option chain, the way that I think about it is the option chain is kind of like an advertising bulletin board. Think of the old cork board where if you have like a lawnmower for sale, and you go stick a pin in a piece of paper and it says you have it for sale. Well, this is kind of like that bulletin board, but instead of selling lawnmowers, these are potential contracts that can be purchased. And those contracts can go from as little, in this case, for Allstate, and this can vary from one stock to the next, but we can see there are contracts for as little as 31 days or for as long as 360 days. They can be much shorter than that with other stocks. They can be much longer than that with other stocks. But these contracts can be purchased through the 20th of February of 2026, all the way out to the 15th of January of 2027. And there's also a number here, 100. What does the 100 mean? Well, that just means that instead of for the purchase of one house, this is for the potential purchase of 100 shares of Allstate. So these are what we call standard options contracts. It's standard for options to trade in 100 share lots. So how about we look at, let's say we thought the stock is likely to go up to 215 over the course of the next couple weeks or a month. How about we go out to the 20th of March? Let's see if we can get a contract for 59 days. Let's give it enough time to see if our thesis is going to work on the stock or not. So I'm going to click on, if you'll notice what I just did, there's a little arrow right next to the 20th of March. If I click on that arrow, it expands and shows us all of this information. Well, these are different contracts that we can get into for the 20th of March. So some of these contracts are what are known as call contracts, and some are known as put contracts. I'm not going to talk about put contracts today. We're going to stick with calls, but I'll give you a resource for learning about puts. All right, so I'll tag that in toward the end. All right, so down the center here are what are called strikes. These are prices at which we can strike a deal to maybe trade shares of stock with another investor out there. So 95, 150, 185. With our stock trading close to 195, let's do this. Let's go strike a deal where we have the right to buy 100 shares of Allstate through the 20th of March for $195. That's what this strike would imply. And that looks like that's trading between 690 and 780. Let's sort of split the difference. So right here are sort of the market prices of these options, depending on whether one is buying or selling the option. But about halfway in between those two is going to be about, what, 745. So here's our deal. We're going to buy the 20th of March 195 call for, and let's assume a purchase price of $7.45. Now this is quoted on a per share basis, but these contracts are for 100 shares. So what's the actual cost of this contract? $745. Okay. Tally says, why wouldn't we buy one at the lower price? It's a good question. Does it have to be purchased right at the current price of the stock? No. We could get into a contract where we have the right to buy shares at a lower price. It just costs more to do that. When we spend more money on these contracts, there can be pros and cons to that. Yes, it allows us to buy the stock at a lower price, but it also lowers the leverage of the trade because we're getting just closer to the cost of the stock. Or we could spend less money and buy a contract that allows us to buy the stock at a higher price than it's currently trading for. It's not as advantageous, but it also doesn't cost as much. So there are pros and cons. All right? Noodle brains are getting a little bit too deep in the weeds for me for this discussion. It's a good question. I'll give resources for people to understand that. Noodle brains just said, would you still buy even though the VIX is high? A lot of people just said, I don't know what you're talking about, right over my head. That's okay. There's going to be more to learn after this webcast is over, but I just wanted to introduce the concept of what options contracts really are. Okay, not get too deep in the weeds. Anyway, but just for this example, let's just choose the strike price that's closest to the current price of the stock. We refer to this, if you want some trader lingo, so you can sound cool at the next cocktail party, that means the at the money price. At the money. This means it's close to the current price of the stock. But this is going to be our deal. So let's say, and as a matter of fact, let's do it right now. Let's buy a call here. So let's go for that 195 call. I'm going to click to create a buy order. This is how it's done on thinkorswim. We're in the simulated trading environment, so this is for practice. It's not for real. There's no real risk here. But I'm going to go to the 195 strike, and I'm going to click on the ask price. And as I do that, it brings up an order to buy 10 of these contracts. Let's just do one. That would be the right to buy 100 shares of stock. So we're going to buy one of these things for the 20th of March, 2026, the 195 strike. And let's see if we can get this done. I can use a little slider bar to say how much is the most I'm willing to pay for this. You know what? I'm going to go ahead and dial it right on up to what's known as the natural. That's kind of the market price of these contracts. I'm going to set that as my limit price. It's not a guarantee that this order will fill, but I'm just saying that's the maximum that I'm willing to spend. So I'm going to click confirm and send. And this has given us a pop-up here that allows us to review. It's our last chance to back away before actually committing to the trade. Gives us a little reminder here. This is a simulation, not a real trade, but we're going to buy one of these contracts. We're going to have the right to buy 100 shares of Allstate through the 26th of March at $195, and that's going to cost us a maximum of $780. Right? If that order fills, then we'd also pay a commission of 65 cents, not per share, just 65 cents total, bringing the total cost of this trade to $780.65 as a maximum. Now notice it's also telling us how much we can make or lose right here. We can make an infinite amount, true. We can lose the full investment, also true. Let's send that order off and see if we can get this filled. Let me go to the monitor tab. This is where we go to monitor the progress of any trades that we placed. And our trade right now is what we call working. So I'm going to go to the working orders, and we're offering to spend $7.80. It was trading for $7.35. Look at that. We filled at $7.55. There we go. So let's open up our left column here, where I'm keeping tabs on this. We didn't buy it for $7.45. We actually bought it for $7.55, or $755. So let's go back to our trade tab, and I just want to talk through what in the world did we just get ourselves into? Well, here's the actual deal. We just spent $755, or in other words, $7.55 per share. But for the next 59 days, we have the right to buy 100 shares of Allstate for $195 per share. All right, that's the contract. Let's go to our chart and see what might happen with this contract. Okay, YouTube says, who takes a simulated trade? A simulated trader. It just follows what's going on with the markets and simulates it as though we actually did a trade. Yeah, there's not another party on the end of this fake trade. It's just a simulation. But the nice thing is, it's actually a very nice, accurate simulation. This is very much like trading in a real environment. There are degrees of differences, but when we're just learning about a concept, it's a great way to learn with no skin in the game. That's why I say might be a good idea to download thinkorswim paper money and get acquainted with it, right? But in any case, let's look at what might happen with this option, and let's also learn, why do we refer to this as a long call option? Well, long is just a term that traders or investors use to say that they just bought something to initiate a new position in it. So when we buy a stock, it would be completely accurate to say, I am now long that stock. If we buy an option, I say I'm long an option. So another phrase that we might use instead of saying a long call is buying a call to open a new trade. All right? The call is a descriptive term for the contract itself. The way that I think about this is back in the old days. I've been around long enough to remember this. When computers weren't around, we didn't trade over a computer. We traded over the phone. And we might have gotten into one of these contracts over the phone. And so let's say that we did that. We have this contract that says that I can buy shares for $195. And let's say I want to buy those shares. I might have made a phone call and say, hey, I want to call those shares. I want to buy those shares. So to me, I just think of phones with this sort of thing. We're making a call to exercise our contract. Anyway, it's not exactly the reason why it's called that, but it's close enough for me to make it meaningful and memorable. So what can happen to these contracts, and what might the trader do with it either before expiration or at expiration? Because that's a big deal as well. One thing that we don't have to worry about is just because we have the right to buy shares for $195, it doesn't mean anybody can make us buy those shares before expiration. All right. Yeah, he even says, and the commissions back in those days were outrageous. Commissions nowadays, a lot of us can relate to this. Yeah, way more efficient marketplace for traders than it was not very long ago. Anyway, so here's what the trader thinks might happen. Let's envision exactly this happens. Let's say that maybe by same time next month. Today's the 20th of January. Let's say by the 20th of February, a month from now, the stock is up here at $215. Hey, awesome. We have a contract that says we have the right to buy those shares for $195. So if the stock is worth $215 and we can buy it for $195, what's the value of that contract? It is at least 20 bucks. We bought it for $7.55. In that case, it would be more than a doubling, almost a tripling of the value of the contract. That's a big if. But yes, the fact is, if the stock goes up to $215, that contract will be worth at least $20. And I say at least because there's still time on the contract. A little bit of time value left on that. So it might be $21, something like that. But that could happen. You know what else could happen? Maybe it doesn't go up that far, or maybe it goes down. What if it only goes up to 200? Let's say we thought it was going to go rocketing up, and it's working its way up, but by halfway through the terms of the contract, halfway to the 20th of March. Oh, it's kind of nice these are all the 20th. It doesn't always work out that way. Here it is, the 20th of January. We're talking about the 20th of February out to the 20th of March. Anyway, let's say we get halfway into this contract and the stock's just barely moving. It's gone from 190, it's right at 194. It's maybe up to 200. Well, we have the right to buy this $200 stock for 195. So it has $5 of intrinsic value, and there's still some time left, but it might not have moved very much in the total value of that contract. Maybe it's worth $8. Maybe it's worth $9. But at that point, the trader might decide, you know what, maybe I'll just sell this. And they go place a sell order for the contract. So are we stuck in this deal all the way till the 20th of March? No. Assuming liquidity, and one thing that a lot of options traders will do is they make sure that they stick with just like the most heavily traded stocks. They tend to have the most liquidity in their options. Maybe that trader just sells that contract. And it's possible, maybe they only break even, maybe they make a little bit of money. It's possible they might even lose a little bit of money if the stock isn't moving. Now, Tali says, if I decide not to buy it by the due date, do you get our money back? No. Nope. Here's one thing that we need to discuss. It is extremely important. Is your radar up? This is a big deal. Let's open up our chart a little bit here. I'm going to hit this expand. Down here, there's some double-headed arrows. It just allows me to add more space to my chart. It's called the right expansion settings. So I'm going to change the right expansion settings. Let's push this out another 50, let's push this out 50 trading days. So if I click apply, click OK, what we can then see is here's the 20th of March. That's when our contracts expire. Let's suppose this happens. Let me just remove this drawing. Let's extend this drawing out to here. Let's say we're up, oh no, let's do it right like there, right at the intersection of 215 and March 20th. So let's say that our stock is up there at 215 on March 20th. So the stock's worth 215. We have the right, we have a contract, says we can buy the shares for 195, and for whatever reason, maybe we decide, I don't want to deal with it. I don't want to buy the shares. Or maybe we fell asleep and we forgot. Well, this is what we call an in-the-money contract. There is $20 of value there. In trader speak, we say it's in the money. It has some value there. If we have the right to buy shares for more than they're worth, and we don't do something about that at expiration, the brokerage firm steps in and does it for us on our behalf automatically. They will automatically exercise this contract if there's even a penny of value in it at expiration. In other words, if we are 1 penny above 195, that contract will be exercised and we buy the shares. So if we buy the shares at 195 and they're worth 215, well, good, that's doing us a favor. It's salvaging the value of that contract for us. So Gene says, I'm scared. I tried to invest. The market's not stable now. Got tough news for you. It's never stable. But no, you're right. I get what you say. Are there some big issues going on? Are there some tariff tensions between countries at the moment and all kinds of other things that could cause additional volatility? Certainly. Could it cause an investment like this to fail? Yes. So what about failure? What if the stock starts going down? What if it goes down and here we go, March 20th has arrived and our stock has fallen in value. Let's say it's only worth 185. Well, we have the right to buy the shares for 195. They're not worth 195. That contract just runs out of time. It just expires worthless. It's not exercised, that we don't worry about that. It's what we call out of the money. It has no value. So in that case, your 755 is not returned to you. Nope. This was an investment that didn't work out. So that's the theoretical worst case scenario in this trade. Now, if a trader sees this as likely to happen, let's say we're halfway there and it's going the wrong direction, maybe instead of letting this go all the way to expiration and losing all the value in their contract, well, there is still some value in most contracts before expiration. So maybe we sell the contract, $4, $3, $5, whatever. Just sell it to get get that value back. But this is what's known as a long call option contract. All right. So I've actually covered the points that I wanted to do. I'm going to keep an eye out, see what other questions roll in, because I know there are a bunch of them. Okay. Like somebody says, what if you want to trade for less than a week? What's a good game plan? Well, we talk about shorter term trading, but obviously I can't lay out pros and cons of that in just a couple of minutes. So let me give a resource for you guys instead. This is just a quick reminder that there are other webcasts, much like this one, along the same lines that we've previously recorded. So if you haven't subscribed to our Trader Talks channel on YouTube yet, please do that right now. So another quick reminder, our channel on YouTube is called Trader Talks Schwab Coaching Webcast. You can subscribe just by clicking the subscribe button down below. It doesn't cost anything. It only takes a moment. But that's where you can join our live streams. But you can also find these playlists. There's something specific in my playlist that I want to point out to everybody. Okay, let me go to the playlists again for my webcast series. So we click on playlists, we scroll down to the bottom. It's this one right there, Getting Started with Options. But I've actually constructed a series of lessons for people who are brand new to options trading, and I build it up in what I call building blocks, understanding how these things work, because we've talked about call options. We haven't even talked about put options. We've not discussed these things known as Greeks. We don't know how options are priced. There's a lot still to learn. So let me scroll on down. And by the way, these just go backward in chronological order. And the lessons that I put together, I did that some time back. So just scroll for about 10 seconds or 20 seconds, and and just keep your eyes out for the words lessons, and it'll just stand out to you. See those? Lesson, 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 lesson. So there's lesson 1. Trading options block, building block number 1. Trading options, building block number 1. Long calls. That's what we just talked about. And we move on to long puts here. Short calls, short puts. We even get into multi-leg strategies and the options Greeks. You definitely want to check out that series of lessons. Now, that's one resource that's available to you, is the archives on the channel. Another resource that you should be taking advantage of is communication with your Schwab presenters, which can only be done through social media. Can't have my email, but you can have my social media handle. So do yourself a favor and follow your favorite presenters on social media. You can find Mike. Mike Fairborn's been helping out in the chats. You can find Mike on X. Go to x.com and look at Mike Fairborn CS. Now you can find me on X. Go to x.com. Let me go here. There we go. That's actually my LinkedIn. Let me pop over to X first here. There we are. But my X handle is at Cameron May CS. So go to x.com, at Cameron May CS. I'm very active here. I just made a post just before this webcast kicked off about what's going on with the markets. I wanted to see what my followers think. Are we going to go up to those January highs, or maybe down to the December lows? And if you reply to one of my posts on X, I try to reply right back to you. I reply to well more than 90%. Every once in a while, somebody will say something that's maybe too politically sensitive for me to get into, something like that. If it's too hot to handle, I don't answer. But if it's just business, hey, let's talk about it here. Now, another place to connect with me on social media is to go to LinkedIn. You just, as you just saw, you can follow me on LinkedIn. You go to linkedin.com/in, and then my handle is /Cameron May CS. And if you reply to me on LinkedIn, I try to reply right back to you as well. I just started my LinkedIn profile, so only a couple hundred people following me at this point. But yeah, follow me on X, follow me on LinkedIn. It's the very best and really only way to connect with me in between the live streams. But time for me to let you go. We've gone through just what we want. Well, first of all, went through that story about what a long call option is. Then we looked at an example, and we've even placed a trade on long calls. So kind of broke the ice. So everybody, thanks for giving me your time today. I do hope to see all of you again when we rejoin next Tuesday for another discussion of getting started with options. But be aware that I have other regularly scheduled webcasts every single market day. If the markets are open, and as long as I'm not on vacation, I'm here doing another discussion on another topic. So for example, like on Thursdays, I have a webcast series that's called Investing in Dividend Stocks. I'd love to see you in those Thursday webcasts. Mike, thanks for helping out in chat. Everybody, been a lovely time. Thanks for giving me your time. I will look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.